Right, so in this video, I'm going to talk a little bit about raising capital choices and choices associated with raising capital. So when a firm is choosing to raise capital, one of the things that they should evaluate is where on that weighted average cost of capital graph is the firm. And that graph is something I've shown in a prior video, but to refresh your memory, let's kind of go back here a little bit. So basically, if I'm looking at this graph, the idea is the firm wants to be at the low point, wherever that low point is. Maybe the low point could be over here for some firms and industries, or over here for some firms and industries, depending on where the curve happens to be on the graph. In this particular graph, this is where the low point is. So I just want to emphasize that the low point is not necessarily evenly between equity and debt. It's just there's a low point on the graph somewhere, right? Depending upon the particular industry and company. So what we're going to look at is where is the company now? So if I'm looking at that situation, if the firm has too much debt, then what that would lead to is we should issue stock or use retained earnings basically to get more equity and to shift the capital structure. So basically, if the firm finds itself over here, that's suboptimal. This is the optimal spot. This is suboptimal. So the idea would be issue stock, use retained earnings, try not to borrow, because then over time, as the proportion of equity increases, the company would slide down towards that low point, which would be preferable. If the company has too little debt, then it would basically say if the company needs capital, go out there and issue debt. So if the firm finds itself way up here with lots and lots and lots of equity, it basically says, okay, well, we should borrow, generally speaking, and that would tend to move us down this direction. Now, if I think of or look at a company, it's possible that if they're just super profitable, they're just getting so much in retained earnings, the company could be borrowing money, but they get so much in retained earnings that it could be hard for them to actually, kind of move this direction potentially. So that could be a little bit of an interesting problem, but not a bad problem to have if the company is just that profitable and it's creating that outcome. Now, a more perhaps a more common situation that we might face would be one in which we have some interesting challenges from an economic standpoint. So when you're trying to figure out what a company should be doing, let's not lose track of the economic circumstances here. So if the economy is in a contraction or kind of in a trough, sort of the bottom of the economic cycle, oftentimes that's not necessarily a great time to issue stock because the stock price is super low. So if you try to raise capital, you have to sell a lot of shares to get a certain dollar amount of capital. So you're kind of almost giving away part of the company at that point. And also, if the economy is really bad, then borrowing rates may be kind of lousy. So issuing debt may not be very attractive at that point. It's possible that if the economy is really lousy, maybe short-term loans to the federal government may have really low rates, but corporate borrowing rates might not have caught up to that yet. Because lenders may still be worried about whether corporations are going to survive the rough economic circumstances. So it's possible that you could be in a certain situation where it's not a great time to be selling stock and borrowing costs are just not great at the moment. And so that could lead the company to be sort of a little bit of a bind of, how do I raise capital in an economic way? And it kind of starts turning into, what's the least bad option potentially if the company really has to raise capital. And in general, if interest rates are, perhaps historically high, that's probably just sort of generally speaking a poor time to issue debt. And so at that point, a company may be looking at a situation and trying to think, well, does it make sense to limit dividend growth or something like that to retain more because, man, borrowing costs are just really kind of high. Maybe I don't want to get tied into that level of borrowing costs at this point. So there can be some interesting economic circumstances that kind of affect what a company is trying to do and what is a feasible set of options when raising capital. And so you have to kind of consider that bigger picture when making decisions. It's not just, hey, it looks like I should borrow more. Well, we also need to look at, what does the economic situation look like, and maybe I should borrow more from a capital structure standpoint, but now is just not a good time for it. And so you kind of have to use some judgment and assess that situation. All right, hopefully this little discussion has been helpful. Thank you so much for watching, and have a great day.